Well, India's largest IT company by revenue, Tata Consultancy Services, has come out with its Q1 numbers for FY20, and that's the reason why we've broken into regular programming to get you this breaking story. So the numbers are flashing on your screen as we speak. It's loading on my laptop, but first, very quickly, let me talk about the top numbers, the top points that we were expecting. We were expecting revenues to come in with a growth of about 5.7%, and in constant currency terms, we were expecting revenues to come in at about 5.1%. So far, in terms of the top line figures and the bottom line figures, we have the top line figure for now. Just give me a second. I'm just loading this. All right, we have the top line figure. It seems to have come in line with our expectation. So far, we just have one figure with us. We are trying to get all the other details, and we're going to get you. But let me very quickly take you through what we were expecting. We were expecting revenues to come in at 38,795 crore rupees. Okay, so revenue has come in at 38,322 crore rupees. So 38,322 crore rupees is the top line figure as far as rupee revenue is concerned. Now, the constant currency revenue has fallen higher than what we are expecting. So on a year-on-year basis, it's fallen by 6.3%. I'm trying to get the exact constant currency figure, but just to reiterate, the rupee revenue figure, 38,322 crore rupees. So it's an increase of 0.4% on a year-on-year basis, and constant currency revenue 6.3% year-on-year. Operating margins at 23.6%. We were expecting operating margin to come in at 24.3%. Let me bring in my colleague Reema Tendulkar as well. Reema, do you have the other figures with you? I'm trying to get the dollar revenue figure.
No, I don't have the dollar revenue, but based on the numbers that we can see on your screen, there seems to be a bit of a margin disappointment. So margins have come down by 150 basis points on a quarter-on-quarter basis. The street was expecting a margin fall, but to the tune of about 50 to 80 basis points. So this 150 basis points decline in margin has come in as a bit of a negative surprise, because this is the quarter when you had a near 5% rupee depreciation, and companies put in a lot of effort to cut back on their costs. You didn't have variable expenses. You could have cut back on variable costs. Travel was not there for employees. So in that context, considering constant currency revenue growth has come in at minus 6.3%, and that would come in as a disappointment. Remember, the street was working with anywhere between 5 to 6%. Our poll itself was close to that 5.2% decline in constant currency terms. So a 6.3% decline in constant. Okay, these are on a year-on-year basis. What we will await is actually on a quarter-on-quarter basis. These are the constant currency revenue growth figures on a year-on-year basis at 6.3%. Dollar revenue numbers will also get flashed for you on your screen. So right now, the only number that we can work with is the margin decline at 150 basis points fall. It's actually worse than what the street was anticipating. The companies indicated that constant currency revenue decline is at 6.3% on a year-on-year basis. We were working with a fall, but this appears to be a tad bit more than what we were expecting. If we have any kind of reactions, we could get to them. Do we have our guests lined up? Okay, we have Moshe Khatri. Moshe, if you could tell us a constant currency revenue decline of 6.3%, how would it compare with your expectations? These are numbers on a year-on-year basis.
Yeah, I would say probably a bit worse than expected, but I would emphasize the word a bit. And the real question here is, one, how quickly was TCS able to move to a remote or working from home kind of environment during COVID? That's number one. Number two, I guess the margins were also a bit lighter than expected. And again, that's probably a function of how quickly we were able to move into that remote delivery model. But, you know, look, between you and I think the June quarter is not going to be pretty for a lot of vendors. The real question here is what the company's seeing on a forward basis. And you know, on a relative basis, I think that the deal pipelines are looking better for the industry, and if we're able to show some improvements in terms of awards and a pickup in awards, I think, you know, we should be in a pretty decent shape.
Okay, just hold that thought, Mr. Khatri. We are also being joined by DD Mishra from Gartner. But very quickly, let me talk about a little bit more color with respect to the numbers. We have the PAT figure as well. I'm still waiting for the dollar revenue figure. The PAT is also slightly lower than what we are expecting. So we are expecting PAT to see a fall of about 4.5% at 7,690 crore. It's coming at 7,008 crore rupees. So a little bit of a disappointment over there. But as far as commentary is concerned, the management has laid out the areas that have been affected by the COVID-19 pandemic. So Rajesh Gopinathan, the CEO, says that the revenue impact of the pandemic played out broadly along the lines that they had anticipated. It affected all verticals with the exception of life sciences and healthcare, with varying levels of impact. We believe it has bottomed out. Now, this is very important. We believe it has bottomed out and we should now start tracing our path to growth. Now, let me bring in Mr. Mishra on that point. Mr. Mishra, the point that the management had laid out last time was that by Q3, they should be back to the growth levels that they had seen in FY19. Would you then agree that this perhaps could be the worst performance taking in the full impact of COVID-19 pandemic?
I would not say that this is the worst performance at this point in time, because the worst is yet to come, and the second quarter and third quarter results are going to be needs to be verified, because at this point in time the impact is coming, and the process will continue till fourth quarter, and that is where we feel that it can be worse than what we can anticipate at this point in time.
Okay, some more internals to share with our viewers. The company's BFSI growth is at minus 4.9%. It had declined in the previous quarter. This quarter, it's at minus 4.9%. This is on a constant currency basis year on year. Retail and CPG, that is where the bulk of the hit is coming, because this retail and CPG vertical for TCS houses your travel, tourism, as well as hospitality, sectors which are directly impacted by the pandemic. That has shown a decline of 12.9% on a year-on-year basis. Retail is down 12.9%. That shouldn't come as a surprise. The question is, has that also bottomed out? BFSI has also seen a decline. That is down 4.9%. Actually, all the other verticals, as the management indicated, have shown a decline. Communication is down about 3.5%. Manufacturing, which got hit on account of the lockdown, is down 7.1%. Technology and services is also down 4%. As they indicated, only healthcare is the one which has grown smartly, a double-digit growth coming in. But the two key verticals to focus on are retail and BFSI, because they contribute nearly 45% to TCS's revenues. Their retail is down 13% nearly, and BFSI is nearly down 5%. Demand contraction, the company says, was broad-based across geographies. Other than Europe and Latin America, growth has declined in all the key markets. North America is down 6.1%, UK is down 8.5%, and India is down close to about 27%, though India is not a big contributor. The company has also indicated, I think the deal wins are out. The contract value in this quarter is at $6.9 billion, and this is a fairly healthy number. Yes, it's lower than the deal wins they had in the previous quarter, which was at $8.9 billion. But at $6.9 billion, this is a fairly healthy,
Well, Rima was making the point on the deal wins at $6.9 billion, as Rima was pointing out. If you even compare it to the last quarter, they'd actually seen two large deals coming in. So 6.9 is significant. Mr. Mishra, coming to you again on the aspect of deal wins. The fact of the matter is that TCS has been fairly consistent, but this pandemic that has hit them could perhaps hit supply more than demand. What do you make of them being able to sustain this deal win?
See, there has been a large pipeline, and these are some of the wins which you see that has been in the pipeline for some time. But that is why I will go back to my point that in this quarter, you will not see the full impact. The bigger impact is expected in the next quarters, and we need to be very careful about that. Keeping in view that TCS has got a very big exposure to the BFSI market, and almost between 30 to 40% of their revenue comes from that particular sector, which is not performing very well at this point in time and is impacted by COVID-19. So at this point in time, if the deal wins are good enough, I'll not be surprised. But from an impact perspective, we need to wait and watch, because the situation is evolving and there are a lot of unknowns at this point in time.
Absolutely. We are also joined by Aniket Pandey from Prabhudas Leeladhar and Prakash Diwan. Aniket, quick question to you with respect to the geography breakup. We see retail being arrested with a 12.9% decline, but BFSI as well, which was supposed to see a softer hit when compared to the other sectors, has also fallen 4.9%. What are the sectors that will perhaps continue to see a decline? And do you agree with Mr. Mishra's point that this is not the worst yet, the worst is yet to come?
See, I believe that decline in BFSI was on expected line, because due to the lockdown, there was a certain impact coming from its ODC business. And in this quarter also, as lockdown was increased by 1 month, so there was an impact coming from its ODC business. And coming from the retail point of view, actually, you see most of the US retail companies are facing a lot of headwinds. And this retail headwinds are there since last 2 quarters, and they are getting exaggerated right now. So going forward, we believe that BFSI, retail and manufacturing are going to see, are going to face headwinds in next quarter also.
Prakash, Rajesh Gopinathan has made a very important comment saying that the decline that they were seeing, or the full impact of COVID-19, has bottomed out, and we should now start tracing our path to growth. Do you believe that Rajesh's earlier comment of them getting back to the earlier growth rate in Q3 could be on track, or would you perhaps give it till the Jan to March quarter, that is Q4, for them to actually see a rebound?
So, Kritika, I'll tell you what, first and foremost, the fact that these numbers have missed estimates very clearly tell you that the estimates probably were faulty in terms of, the damage that we expected was not as bad as the reality tells you. That's number one. So I think the starting point should be that these numbers give a very grim picture of how deep the problem is or the challenges. Having said that, I do agree with Aniket when he said that retail is the one that's likely to kind of continue getting challenged, because that was a trend that was pre-COVID as well. But BFSI, you will be surprised, in a lot of other markets, especially in the UK and US, has adapted very well to still be able to sell products and continue doing business and servicing clients, whether it's insurance, whether it's mortgages, all of that is on. Incrementally, the financial services sector is going to undergo a lot of headwinds, but that doesn't mean that the service providers like TCS will get impacted immediately. Their work continues, their servicing continues. So I would actually agree with Rajesh Gopinathan's view that things could only improve from here on as we go along. Now, whether it happens in the September end quarter or we'll have to wait till the December end quarter is a question that will get answered as we see commentary come through. But I would not write this off. The only worrisome part here is the kind of depreciation in the dollar that you could probably stare at, and I think that's a reality that we need to understand, that the rupee vis-a-vis the dollar could probably take away some of the gains for these companies, where the revenue is coming from global plays rather than domestic businesses. So that's the only worrisome part. But otherwise, I think this could probably be the first sign of the weakness having impacted, but also the fact that things would only improve from here on in subsequent quarters.
Okay, just a very quick side note as well. The attrition is about 11.1% in the company. I want to just reiterate the point that Rajesh Gopinathan had made last quarter, that they are going to try to protect jobs at the cost of salary. So this higher attrition should largely, I don't believe that it should include involuntary attrition. The dividend per share is 5 rupees for this quarter. So this is in line with what TCS has been maintaining with respect to their capital return policy to shareholders. If we have Mr. Khatri with us, Mr. Khatri, if you put all the large IT companies stacked up together, what Okay, we've lost Mr. Khatri on the line. I'm going to pose that question to Mr. D.D. Mishra. So if you put the large IT companies stacked up together, in terms of margin levers, TCS had started going towards its target band of 26% odd. How long do you think they will take to be able to reach there? Would you perhaps push that target to FY21, FY22?
See, the recovery which we are expecting, I mean, this is, I agree to the point that the impact is not going to be very long, keeping in view the situation as of now. If it doesn't get any worse from here, the recovery is expected in 2021. So we would expect that the things will start changing. And if we look at the forecast Gartner has made so far, even though we keep revising the forecast depending on the situation, next year we see that the growth coming back, and whatever has been stalled for this particular year probably will contribute to the growth next year. But having said so, we have to keep our fingers crossed at this point in time, because this is an evolving situation and we cannot predict too many things at this point in time.
Okay. I just want to now talk about the sequential decline that we've seen in revenues on a constant currency basis. We've been saying that on a year-on-year basis, revenues were down 6.3%. But we look at IT companies on a quarter-on-quarter basis, and they have just derived what the sequential fall would be, and it would be about 6.9% to 7%. Now, that is much worse than what the street was anticipating. The street was working with a 5 to 6% sequential decline in revenues. It's coming closer to the 7% mark. Now, this, remember, is derived. We'll still await the management commentary on that. But pure say, in a nutshell, TCS Q1 revenues and margins have disappointed the street. Revenues have fallen by close to 7% on a constant currency basis, and margins have fallen by 150 basis points, driving a decline in their profitability. However, what will give a positive spin to the numbers is the fact that the management has guided that growth will return from Q2 onwards. So that will be taken well, and deal wins continue to be fairly robust. Ankit, if we have you with us, if you could just tell us, how do you expect the stock to move from here on?
So see, yesterday in ISG call also they mentioned that they have trimmed their growth forecast for Q2 FY20, and impact was 1% lower than their expectation. Okay, so ISG is also building a 3% QOQ sequential growth from Q3 CY20. I think this result is not about. I think these results is not about numbers, it's all about commentary. So going forward from Q3, actually, we will also see a pent-up demand in the aftermath of pandemic. So as all the Fortune 500 companies realize the importance of technology, which would be cloud security and experience, and I think that will propel growth forward for TCS.
Okay, we are going to get the management very soon with us. The management is set to address the media, but via virtual press conference. But very quickly, I don't know why it took us so long to get the dollar revenue figure. The dollar revenue figure is finally out. It's $5.06 billion. We must pull through up about $5.1 billion. So it's a miss on that count as well. Very quick word to Mr. Khatri, if we still have him with us. Mr. Khatri, very quickly, if you stack up all the companies together, how well placed is TCS above its peers at this point, keeping the point in mind that perhaps the COVID-19 impact is going to continue well into Q2 as well?
Well, first of all, I don't agree. I actually disagree with the notion that this will get worse in the next quarter. I do believe that we've had the pause in April. Things are looking better in May and June. Most companies are very well battle-tested in terms of their ability to work or deliver under the new COVID kind of era rules. And if we believe that pipelines are starting to get converting or actually starting to convert, that will convert into better growth in the September quarter. So we believe that the likes of TCS, Infosys, HCL Tech are very well positioned to show that recovery. So we belong to the camp that believes that things have bottomed out and we'll start to see better numbers in the next quarter.
Prakash, how do you expect the stock to move from here on? It's just earlier this week, it hit its 52-week high. It's seen a smart rebound. Valuations are no longer what they were around that COVID time. It's a 24 times forward multiple. Considering what you've heard, what is your own estimate of the stock to move tomorrow?
That's the interesting part. We've all priced in, a move into the stock because everywhere else the market was kind of reacting positively, and Infosys led that whole up move in the IT sector. TCS actually followed suit. What I believe would happen is still the Infi numbers are out. The stock could probably have a lid on its further up move. But once the Infi numbers are out and people have enough ample data points to compare the two, I would believe that TCS would see a second bout of buying and belief in the commentary once it's out, if things are looking at improving. As I said earlier when Kritika was asking me, I don't think we'll see anything worsening than that. Yes, the estimates have been a bit optimistic, and that's why there's disappointment and there's a negative beat on this. But going forward, things could start improving. So people will probably be...
Prakash, I'm sorry, I'll have to interrupt you there because the management has started speaking. Let's cut across to Rajesh Gopinathan, the MD and CEO.
Expansion of SBWS from beyond just service delivery to all aspects of our organization. This has included executing more than 32 transitions in a completely digital, contactless manner. And in the process, we are very happy to have onboarded hundreds of new associates from many of our customer organizations across UK, Europe, and North America. So this quarter, the first quarter of financial year 21, has been a very satisfying quarter from an execution perspective. But the story of Q1 is not about SBWS and execution. The story about Q1 is about the amazing TCS family that has come together and stood shoulder to shoulder as one TCS and has defined our organizational response both internally and externally to this crisis. It's a story that is unimaginable in its scope and the impact that it has had, not just on us as an organization, but on our extended ecosystem of both our customers and the various other stakeholders that we touch every day. To take us through in a very brief way and to do justice to what has happened, I want to call upon Milind to share a few words before I go back to talking about the actual performance of this quarter. Milind, over to you.
Thank you, Rajesh. Thanks everybody for taking the time to be here. As mentioned earlier in our last quarterly briefing, in these challenging times, for us, associate health and well-being is paramount and has been a key factor for all our decision making. Over the last 3 months, we have not only connected with 400,000 associates on one-on-one basis, but we also connected with all of the 40,000 fresher recruits coming one-on-one and who will be joining us from mid-July through the year. To address, associate mental and physical health, it is, like I said, associate health and their well-being is paramount for us. And that has been a key priority, the key factor for all our decision making. So we have taken various steps, establishing a global medical hotline. We have a very large counseling services network even before COVID. We expanded that network quite a bit. Provided quarantine facilities across all major cities. To our associates, enabled repatriation, people coming back from various countries back to India. Establishing one TCS channel, where we got motivational speakers to come and speak about various things, to keep our motivation of our people high. The CEO and senior management town halls, so important in these situations where we have to continue to basically, the senior management comes and talks about the big picture all the time to our associates. Enabling social connects for fun, for various social activities so that people can connect outside of the work, and providing a channel for that. And I think, and such as talent hunt competitions, which is going on right now. So it is extremely important that we take care of this aspect of health and well-being, as a core aspect, core strategy for TCS in these challenging times. Everything we do has to be centered around this aspect of it, and everybody needs to understand. We have seen a number of people. Obviously, a lot of us have going through various situations, anxiety, frustration, loneliness, family issues. You can name it, and there are challenges which are going on. And how does a company like TCS, who have been known for our values and culture, come and participate in a much bigger way to take care of our associates' health and well-being? I think very important things which we need to do, we continue to do, and we'll continue to enhance, change, and accelerate some of the things which we are doing here. Very critical. Second point I want to briefly mention is about talent development. Lifelong learning is a core value of TCS. How do we bring in basically that learning into our new operating model was our key priority this year. During this period, we further strengthen our state-of-the-art learning infrastructure, to do various things for our people. And as a result, our learning intensity has gone up almost by 24% in this quarter. We kind of stopped all junior recruitment in the last quarter, and all our fulfillment was done through strategic talent development. About 4,500 positions got fulfilled as a result. It was extremely important for us to connect with fresher recruits during this period, because they need to be reassured that yes, TCS is hiring and TCS will have given you an offer. You will come to the organization. They got delayed because of their academic term getting delayed, but they actually are coming in, and all of them will be joining us from now through the year. Innovative learning interventions, virtual hackathons, where 1,500 people participate every week. These kind of interventions and driving that intensity of learning during this period actually took also some mind away from things where it should not be, and it played a big role in also bringing people's morale up in terms of keeping them busy in the constructive things and not have them think about negative stuff. The third point I want to bring about, and it's much talked about topic lately, is about U.S. President proclamation. This proclamation is unfortunate and unfair from our perspective. From a business perspective, in a short term, we will have some impact, but considering our strong supply and delivery ecosystem in the US, and with our customers adopting SBWS, location independent model of SBWS, I think we will actually be able to manage this situation in a short term. On a longer term, based on how the situation evolves, we anticipate challenges. From a sourcing perspective, as the fair share of students in the STEM discipline are international students. The treatment of international students and potential changes in the OPT regulation in the future will have implications not only on us, but on the future of technology development in the US. I think more importantly, from an associate perspective, this is extremely unfair. It is important for all the stakeholders to understand that the proclamation is causing enormous amount of uncertainty and anxiety to our associates. Remember, these associates help run the major banks, the retailers, the manufacturing companies, the telcos, every day, thereby significantly contributing to US economy. We understand and empathize with our people. This is the situation we are in, we are all in it together. We understand and empathize with our people, and they know that will take care of them during this uncertain situation and beyond. Extremely important for all of us to understand that we are all in it together. There will be situations, there will be regulations, there will be different times. We'll have to deal with it. This is another thing which we will deal with it and move forward. The fourth point I want to quickly bring up, and it gets asked to me quite often, is what are your plans to returning to office? Them during this uncertain situation and beyond. Extremely important for all of us to understand that we are all in it together. There will be situations, there will be regulations, there will be different times. We'll have to deal with it. This is another thing which we will deal with it and move forward. The the fourth point I want to quickly bring up, and it gets asked to me quite often, is what are your plans to returning to office? Currently, globally, 1% of our workforce is working from office or customer locations. During creation of across the facility, risk profiling, self-declaration, many mandatory trainings, and provided very safe transportation and quarantine arrangements, incident response, standard operating procedures. When we detect a case inside the office, all of that has been done. We have also implemented our own state-of-the-art product for risk prediction of our people. As part of this process, and we will actually, this is our alignment with the new normal. With that, over to you, Rajesh.
Thank you, Milind. And as I said, this is a quarter where the TCS family has truly gone over and beyond anything that could have been ever asked of them. And I want to thank each and every TCSer for having done what they've done and for continuing to do what they're doing to make the results that we're going to talk about possible. With that, let me turn to the results and the specifics of it. Could I have the highlight slide, please? Thank you. So we ended Q1 at 38,300 crores, which is a net reduction of 6.3% on a year-on-year basis, broadly in line with the expectations that we had going into the quarter and which we had shared with you at the end of last quarter. The impact of currency further accentuated this from a dollar perspective, but from a rupee perspective, we are actually happy that we have ended the quarter on a year-on-year basis, marginally positive, with a growth of 0.4% in reported INR terms. From a margin perspective, we have been able to deliver 9,048 crores of operating profit, which is an operating margin of 23.6%. And this has been a phenomenal effort by our entire operations, finance, and business folk, because this margin defense has come while we have stayed very, very supportive with our extended employee ecosystem, as well as with our customers who have been going through significant stress. By tight financial management of ancillary expenses and by a very focused approach to it, we have been able to minimize the significant impact that we have seen on the revenue line and defend the margin and keep it within a manageable range. From a net margin perspective, we have ended the quarter at 7,000 crores, slightly more than 7,000 crores, which is a net margin of 18.3%. From a cash from operations perspective, once again, disciplined execution and the focus that the organization has been able to build is coming through and shining through in this number. We have ended with one of our highest cash conversion ratios, with the cash from operations at close to 9,300 crores. Once again, this has come despite a very supportive stance towards customers and also to all our partners and key providers who are an integral part of the overall TCS business model. Our payables, especially of our smallest vendors, has been 100%, and we have continued to maintain that and yet been able to deliver a significant outperformance on the cash side. We are ending the quarter with slightly more than 51,000 crores, and which keeps our overall capital return plan on track despite the significant impact that we're seeing due to this pandemic. From a customer perspective, we are ending the quarter with 4 more customers at 48 in terms of the highest 100 million plus revenue band. But the story on the customer side is beyond the numbers. This has been a quarter where our actual connect with our customers has increased significantly. Across multiple executive levels, our overall engagement has gone up by our estimates by almost 3 times. And we have been able to actually seamlessly switch over into this new operating environment and use that to an overall advantage of increasing both the volume and the quality of the customer dialogue that is happening, and which has been critical to ensure that we are aligning to the requirements of our customer and making sure that we are fully focused on the direction of recovery that we foresee and we are anticipating. From a segmental perspective, this quarter has been along the lines of what we expected. Verticals, especially life sciences, healthcare, pharmaceuticals, etc., they have continued to maintain the growth trajectory and are growing still at close to mid-teens numbers, going at about 13.8%. Most other verticals have been impacted in some way or the other by the overall economic impact of the pandemic. Our largest vertical, banking and financial services and insurance, has had a 4.9% year-on-year decline in revenue. Within that, insurance continues to do better, while capital markets and then followed by banking, which has seen a short-term impact, whereas we believe that it will recover during the course of the second half of this year. Retail, travel and hospitality, and CPG has been the industry that has seen the maximum impact due to the pandemic. The demand destruction in this vertical is significant, given the sheer economic impact that it has had across many retailers. Even within that, there is a full spectrum of both impact as well as recovery paths. And I'm glad to say that we have stood shoulder to shoulder with our customers and have been part of their recovery planning and recovery journeys. And we believe that we will continue to participate in that journey, both in its impact as well as in the recovery as it unfolds. From a geographical segment perspective, Europe, which had been on a significant growth trajectory, continues to maintain a growth momentum, albeit it has been impacted once again by the early impact of COVID. However, from a geography perspective, we see Europe as being most ahead on the recovery curve, and most of our customers in June are seeing good traction and good positive momentum, and we expect Europe to go back to its higher growth trajectory during the remaining course of the year. The United States has been among the most impacted, but also has been among the most resilient and adaptable in recovery and in planning for it. Overall, the sheer magnitude of the impact has been high, with year-on-year revenues reducing by 6.1% to 2.6 billion for the quarter. But as I said, it is one of the most innovative ecosystems, and there have been multiple instances of clients coming up with significant new innovations to deal with the pandemic, whether it be retailers coming up with curbside pickups and other such operational improvements, or our participation with areas like pharmaceuticals and medicines and delivery, which had to be, the supply chain networks had to be reconfigured almost dynamically to reprioritize where the medicines are required and the endpoints where the medicines need to be delivered, which were keeping on changing on an almost real-time basis. Similarly, supply chain changes to deal with the fact that a lot of air traffic had gone off the network, and making sure that critical medical equipment and deliveries are made available, to make sure that the significant support that governments were extending to companies of all sizes were efficiently channelized to the banking and financial services channels, and to reconfigure their systems to be able to deal with that unexpected spurt. All of these are areas where we have seen significant activity and been participating very, very strongly. And
in a nutshell, TCS Q1 numbers disappoint the street. Revenues and margins lower than estimate. The company reports a 6.9% decline in revenues on a constant currency basis quarter on quarter, much worse than the 5 to 6% decline the street was anticipating. Margins fall by 150 basis points, lower than estimate. But the silver lining in the numbers is A, Deal wins continue to be fairly robust in these challenging times at $6.9 billion. And secondly, the management says the impact of the pandemic has bottomed out and the company should now start tracing its path to growth. So that will keep the hope alive for TCS. That's it from our coverage of TCS. We'll be back with the management tomorrow morning. Stay tuned through the day, through the evening for more updates.